Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Tuesday, December 13th, 5:25 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video, the bipolar edition, I guess you could say. State of the market. Uh, let's answer this one tomorrow after we see the FOMC reaction. So we'll go to the trend gauge and then we'll go through what just happened today. So market leaders neutral after today, which was kind of a mixed emotions day, as you can see under the what just happened. Uh, Arrow pointing toward bullish. Same thing with short term versus the 21-day exponential moving average. We've got a mixed bag, some above, some below of the major indexes. Medium term, all the five major indexes above the 50-day. Long term, also a mixed bag. So what happened today? Uh, we were pre-market, we were up about 0.6% at 8:30 when CPI came out, and the CPI numbers were showed reduced inflation, and the market immediately took off to the upside, pulled back, made opened up right around 4,000, so it gapped up about 2.8%, but that was the high of the day. In fact, the high of the day actually was made pre-market, so we didn't get back above 4101. That's kind of the cap. That was that's exactly where we capped last week or the week before, also when Jerome Powell showed some supposed dovishness. And he gets to follow up on that tomorrow with the FOMC result, expected to raise 50 basis points at 2 o'clock tomorrow, and then a press conference after that at 2:30. So made the high of the day immediately and faded down all the way down to negative on the Dow and just barely positive on the S&P. And then we rallied a little bit late afternoon into the close. So my title for today is what just happened is mixed emotions, CPI gap up fades. If you just look at these numbers here, you'd think, not a bad day. But if you look at the way things played out, multiple stocks gapping up 3, 4, 5, 6, 7%, putting in their highs immediately within the first 15 minutes, and then fading most of the day. The exception was solars, which finished, a bunch of solar stocks finished high in their range. That was one of the standout sectors that didn't fade today. So overall, G6 up 0.8%. This is our 6 ETF composite that we use to track the overall growth stock environment. S&P 500 up 0.7, NASDAQ 100 up 1.1, Dow, the weakest of the indexes today, up 0.3. Interesting with the Dow being weak today, growth stocks actually outperformed value, which is a little bit of surprise considering how much we gave up during the day. We had staples finishing negative, discretionary finishing flat, banks quite a bit negative, financials lagged. But growth did outperform value across all market caps today. Mid caps up 0.6, Russell 2000 small caps up 0.8, global diversified 60/40 up 0.7. Bonds were up today, which is no surprise to the reaction as interest rates projected to be capped a bit by the weakening inflation data. That also brought the dollar down during the day also. Now, in-house, we lagged up 0.17. Our beta was about 0.5 coming in, so you'd expect approximately 0.37 to stay in line with our beta of half of the S&P, and that's exactly where we'd be if we didn't get stopped out in the first 15 minutes on our SARC inverse ETF, and that's got us stopped out basically at the top of the market, and then we pulled back the rest of the day. We made a few other changes, and I'll detail those when we get to the tail of the tape. So let's get into it. Active management is what we do at Revere with the overriding theme of protecting client capital in downtrending markets and participating in uptrending markets. Uptrending meaning when we're stacked with the short-term moving average above the medium term, above the long term. That's ideal. We're participating in the market then. if we start to roll over, get below the short term and medium term, and the slopes of those lines start to roll over, the market will take us out because our stops will start getting hit. This is the market telling us that we're weakening. It's time to lock in profits and minimize new buys. If we get below the black line, that's the 200-day moving average. That's when we really get defensive. And the reason for that is this chart here, which you're familiar with if you've been watching us, because this is the devastation that can occur if you're headed into retirement and you get a negative sequence of returns. You lose 20%, 25, 30, 40. In two cases here, in the 2000s, 50 and 57% of your nest egg on a negative sequence of returns happened twice in 9 years. You think it can happen again? We had COVID down 35% in 2020. What if the death rate for COVID ended up being, I don't know, 2, 3% instead of just a fraction? What would the markets look like then? We went down 27.5% January to October of this year. Need 38% to get back to even. We're down year to date about 12%, which is about the most we've been down all year. And very easy to come back from a low 10, 12, 11, 10, 11, 12% drawdown. It's when you get into the 20, 25, 30s that it's a significant slog. In fact, the average of all of these 44.5% severe bear markets, you need 80% to get back to even. You're approaching retirement, you don't have time for that. You're going to start spending the money. It's your nest egg. So that's why our number one job here at Revere is risk management, and especially when we're under the 200-day moving average. So we got under the 200-day moving average and a big inflection point on 421. This was a hawkish speech by Jerome Powell. We had one leg down, rallied up into the declining 200-day moving average, started the third leg down. Since then, we've rallied up again, got above the 200-day for a couple days, failed again, got back above it today with the massive gap up, but you can see where we paused right at this 41.01 level. Same as the day after the 11:30 Powell speech at the Brookings Institute and the press conference where he indicated, kind of all but sort of indicated, that we were only going to cut 50 basis points and see how things play out here. The Fed does not want the market to take off to the upside. That encourages people to continue spending. They're feeling wealthy, and that's going to keep inflation high. Inflation is a huge drain on the middle and lower class. They're actually happy to see this sell-off today. Now, I don't know it's very clear that the market wants to go higher, but right now it doesn't want to go higher than 4,100. I talked a lot about that 3950 median that we've been bouncing around for the last 7-8 months. And apparently right now 4,100 extended to the upside past that is a little too far. If you're at 4,100 and at $225 in earnings per share for the S&P next year, which is kind of generous, that's an 18 PE at 4,100. That's not where markets bottom. So what the market is considering now, and why strength continues to be sold, is what is the recession going to look like? The market seems somewhat convinced that inflation has at least tapered or gone sideways over the last couple of CPI reports, and the reactions have been varied. In this one, it was high. We gapped down, but that was too far below 39.50. We started to jet back up to the upside. And now today we had a surprise to the positive, very similar to a surprise to the positive that we had on 11:10. But 11:10, we continue to go higher. Today we capped at 4,100, reversed. This 200-day moving average was critical during the day. The 200-day moving average is at 40.34. Look where we came down here, 40.38 and bounced. Came down again, 40.40 and bounced. Finally broke below it, and then this flipped from support intraday to resistance at 11:50 today. We bounced back up, the high up 40.33. Sold off down to 39.93, bounced back up 40.24, bounced back up again 40.33, bounced back up again 40.33. So right now that 40.34 level, which is the 200-day moving average, is absolutely a line in the sand. And that's what we'll be watching tomorrow for the reaction. versus Powell, how dovish, how hawkish he is. Um, my expectation is that he'll say, "Yeah, we're going to go 50 here," and then kind of don't expect us to start cutting rates. And then the reaction is, if they don't start cutting rates, how long can we live with rates being where they are? And if we have to live with that, how does that impact the earnings of the S&P 500? Because ultimately, it's a multiple that determines the level of the S&P, an earnings multiple of all the S&P 500 companies. It's historically, in between 10 and 20. It has gone to single digits at severe depressions and or recessions, depressions, sell-offs, the financial crisis. But actually, it was high in the financial crisis because earnings completely uh, went to the downside. So then the question is, what does the market see next year for earnings, and what multiple are they going to apply? Um, So the levels we're trading against on the upside are 4,100. 4034 is the 200-day moving average. Last week's lows, 39.20. Break 39.20, then we get the 50-day moving average, which is currently 38.55 and moving up about 5-7 points a day. So we'll come into that pretty quick. And we may just trudge sideways for a while. We don't predict here at Revere, we react, but it continues to be a sell strength environment. Isolate the strongest stocks. They get too strong, sell them. They pull back to the lower end of the range or a reasonable moving average. You can take another shot at them, but don't think that they're going to the moon, because very clearly the best move has been to sell strength, buy the strongest, but buy them when they pull back to a support level. So there's the S&P 500, Nasdaq 100. Same thing, got near the highs of a week and a half ago and reversed. One close above the 21, can't get back above the 200-day moving average. The strongest of the indexes, the Dow, not the strongest today, but it's capped right now at today's highs, which is 34,700. A week and a half ago, 2 weeks ago, we were at 34,600. So poked its head above, reversed uh, above the 21-day moving average. This has really been the line in the sand for the Dow. We've got one close below the 21, going all the way back to when we first popped back above it in the beginning or mid October. So there's the Dow. Let's go to mid caps now. Mid caps back above the 21, reversed, didn't even get above the highs of 2 weeks ago on the Powell speech, and then IWM also not above the highs of 2 weeks ago, and that high didn't get above the highs of three prior before that. But we've been talking about relative weakness on small caps for a while now. So try to get above the 200, failed, closed below the 21 also. So bottom line, mixed emotions, big gap up, negative reversal. Looked at the final numbers, you'd feel good. You looked under the hood, you'd go, eh. Um, and the playbook continues to be sell strength, buy weakness. So those are the major indexes. Let's go to RSP. Even weighted S&P 500 reversed pretty much the same place 2 weeks ago on the Powell speech, above the 21, above the 200. QQEW, equal weight Nasdaq 100 closed above the 200, made a higher high relative to 2 weeks ago and relative to 5 weeks ago. So that again indicates that the average stock in the Nasdaq 100 is outperforming the big cap stocks. Apple only up 0.7 today. Tesla down 4%. This thing is just toxic. I don't know if Elon had to sell more to prop up Twitter. I don't know if it's just distractions. I don't know if it's an economic slowdown, which he's been talking a lot about. That Tesla will be fine for the long term, but they can't overcome economic weakness. People don't want to buy cars; they're not going to buy cars, depending on how they're feeling about the economy. Plus, you've got some people where Tesla was a status symbol, and Elon with his free speech and a lot of people that used to be big fans are turning on him. It's very evident if you follow him on Twitter. So I don't know if that's impacting who owns a Tesla or not. I mean, that's an interesting dynamic if you think about it. I know one, Alyssa Milano, said she sold her Tesla and bought a Volkswagen, and she was congratulated because Nazi Germany founded Volkswagen, which she apparently didn't know. So where are we now? Let's go to the VIX. VIX down 9% on the day, closed right on the 21, bounced off that 25 level. So this 24 to 26 was support, maybe acting resistance. That's good for stocks, but we absolutely have to see the reaction tomorrow. The dollar gapped down and really stayed weak most of the day, trended higher, but not a whole lot of change in it. And the market didn't seem to be paying a whole lot of attention to what the dollar was doing. Let's take a look at junk bonds. JNK uh, acting great. Hell, this is kind of funny. No credit fears whatsoever. Closed mid-range, in other words, a better close than the S&P did. So not a lot of fears in junk Bondville, or you can call it high yield Bondville if you're an optimist and not a pessimist. Let's look at the TNX, the 10-year. If the price was up, and it was, that the yield is down, and it was, although it did close at the highs of the day and didn't undercut last week's lows. That's the 10-year. Let's go to the 30-year, the TYX. Didn't undercut either, top of the range, but down on the day. So we've got some consolidation here over the last week in interest rates. What did gold do? With the dollar down, you would expect gold to be up, and it was. Close above the 200, bottom of its range. But this was a close above the 200 barely. This is a significant close above the 200 by 0.8%. We'll see what tomorrow brings. GDX. Definitely appears money is flowing into these gold and gold stocks, though. Closed right on the 200-day moving average. So after this move up, a nice little 2-week consolidation, pulled back, held the 21. This is bullish action. This is what you want to see in gold and gold stocks. Let's go to silver, which was leading. Higher high. That's what leaders do. They make higher lows and higher highs, and that's what silver is certainly doing. So those are the other key uh, indexes that we wanted to track. Let's go to the tail of the tape, and then we'll go to the focus list. So um, mixed result. The stochastics on the indexes and the G6 did turn up despite the negative reversal. Put call neutral. VIX 2255. That's bullish. It's at the 21, so that's mixed. Let's wait till tomorrow to decide what we're doing with the bull case or the bear case. We're really a couple percent either way from it being very clearly bullish or very clearly bearish. But then again, 4,100 seems to be the cap right now. And the market spoke loud and clear about what it thinks about getting over 4,100 today. Here were the CPI numbers: 1/10 versus 3/10 monthly, 7.1 versus 7.3 yearly. FOMC 2 o'clock tomorrow. Day count from up 1 to an up 2, although with a negative reversal. Expectations were neutral. Big gap up fades were above the 21, but an above and fail at the 200-day moving average. As far as the levels go, we gapped above the 200, 40.34, but again, above and fail. It's a key level. Keep an eye on 40.34, and it's dropping by about a point a day as the 200-day moving average is flattening out. NASDAQ 100, we gapped above 290 and failed also. Again, note those numbers: 40.33, 40.34, all of the bounces and all the bounces, the failure, and then the attempts to reclaim 40.34 is what stood out to me at today's session. So we're at 40.37 overnight before CPI gapped up to 41.34, so quite a bit higher than where we even opened, which was at this says 4022. That 4022 is what we were at prior to the gap up. 4100 is where we actually opened. 4076 of 4101 was the range. So 4101 during the session, 4134 pre-market on the S&P. Sectors, solars, home builders, but home builders pulled back. Let's take a look at these and you'll see what I mean by where they closed in their range. Here's TAN. TAN below the range on the ETF, but if you look at the leaders, and this has some foreign stocks in it. Keep that in mind. There's First Solar closing right on the 21 at the top of its range. Sedge, SEDG, top of its range and a new high. So very clear relative strength there. Array, which is a very wild stock, closed at the top of its range. And End Phase, these are the Fab Four, so to speak, mid range, but broke out above the level relative to the last 3 days. Now, if you look at ITB, big gap up, but closed at the low of the range. Did a little bit of a breakout, but again, anytime you see the low closing at the low of the day, it's not what you wanted to see. Biotech strong, oil strong, real estate strong with the drop in interest rates. Dollar weak, yields down. Jets weak, banks weak, retail weak, transports weak, and MSOS making new lows. So here's the focus list. We'll look at those charts momentarily. What we did in house: stopped on SARC early, trimmed a quarter of SPXL when we broke back below the 200-day moving average, and then we got a good buy point for Nvidia today. Uh, didn't chase it early. It pulled back and bounced right around that 180-ish level. That gave us a good enough um, entry point with a proper stop over 1 ATR to buy against the 200-day moving average. So we've added 2% Nvidia to the portfolio. So we ended up coming in with a 0.53, going out with an adjusted beta of 0.59. Bottom line, mixed emotions. Big gap up on CPI, fades badly above the 21, but above and fail the 200-day. FOMC tomorrow. You can see no real changes to the support and resistance levels, but this 4034 was huge today. Let's see how that acts going into tomorrow. Now the focus list, which will include everything that we own. Our stocks did their job today. They held up pretty well relative to the indexes. Let's start out with Boeing. Actually red early in the day, or gapped up and sold off quickly to red, but did close up 0.46%, riding for now the 8 EMA higher. Next up is Netflix. We took some profits on this on strength last week, higher, but at the bottom of its range, up 1.6%. Steel Dynamics, we took profits at 111 on this last week. It's at 110.38, continues to ride the 8 higher. PI and Pinge was up nicely, gave it up, finished still above the 21, but at the low part of the range. Five uh, five is following the picture in the yearbook for what you want, or in the textbook for what you want an earnings gap to do. The gap up, pull back on lighter volume to the ADMA, hold the ADMA, was up nicely today at once, over 4%, but pulled back along with the market. But yesterday's low will be the line in the sand for this. We're down slightly on it. We need to see some progress, and that's going to pretty much depend on what the market does. Next up is Mobileye. Mobileye got an upgrade and a price target increase today, closed at new highs. TMDX, incredible story on this. Again, had a nice gap up. It closed at the low, but still up 2.7% on the day. We got stopped on SARC, so let's look at ARKK. Big negative reversal on that. Had the direction right, but got stopped. It happens. FAS didn't get stopped. Right below the 21, top of the range for FAS, which means XLF, very obviously gapped up and then reversed and closed near the low of its range right on the 21. Let's see, and then we bought in a video, we showed that, and then the key charts, Apple, ugly, but closed right on the 21, that 140-ish level, 140 to 145 continues to loom large. Microsoft, One of the best setup of the Nasdaq 100 stocks outside of Netflix, in of the big top 10, top 15, but reversed right at the 200-day moving average today. Nvidia we bought, AVGO we're also keeping a close eye on. Broadcom big gap up above highs going all the way back to June. So nice setup there with volume. Good reaction to earnings. Day three higher high. So you know what that means. I'm putting this on my. I think it's already on the list actually. So we got to track that and see how it acts relative to the ADMA. You can see it kind of touched it yesterday after the earnings gap up. But we do own NVIDIA, and we won't get too heavy in semiconductors. GFS added to the NASDAQ 100 yesterday, a follow-up gap up. It ended up giving up quite a bit of it. Attractive stock, good story, decent pattern, reclaimed the 21. Good volume yesterday, but selling volume today, as long as it's above the 8 and the 21. That's really the line in the sand that we use. That's going to wrap it. As always, reach out to us. We'd love to talk to you. Email don@revereasset.com. You can also email my partner, Dan Stewart. He can answer any financial questions you have and talk to you about becoming a client. That would be dan@revereasset.com, or you can call 855 Real Wealth. That's 855-732-5932. So wrapping up, Tuesday, 12/13, one of the big events of the week out of the way. We got FOMC tomorrow. Let's see what Jerome says. The market will take the direction from him right now. Very obviously, we were capped at 4,100 on the upside and 39.20 on the downside. Those are the two levels that we're watching. So remember, folks, it's not how much you make in the market, it's how much of that you can keep. And wrapping up Tuesday, 12/13, it's Don Vandenbord telling it like it is. Thanks for listening. Have a great day.